Everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to hit up the comment section, see what people are talking about in the comment section. I'll answer some of your questions. I do this very similarly to the question and answer sessions. And sometimes I go on here and I see some that I want to answer. And I'll give you my financial opinions around it. And again, it's just my opinion. Doesn't mean it's right or wrong. Everyone's got opinions. And the only thing I'll say is, I've looked at these markets for a while. I watch a lot of things. And I've got opinions around a lot of this stuff and the cycles and the thesis that basically the channel kind of operates on. So let's dive in here. Let's see what's going on, and I'll give you my opinions around it. So we've got the catalyst for platinum going up is the South Africa energy crisis. It could be, it might not be. Platinum outperformed gold during a highly inflationary period in Germany. It also outperformed or did very well in some of these inflationary periods in the beginning of those inflationary periods. It could be a monetary crisis that stokes it. It could be a combination of demand and supply or any of those factors. I'm not here to try to guess what the future is going to be the catalyst. All I know is that platinum is incredibly cheap to silver, to palladium, and to gold. And when you get guys, engineers out there, they're going to say, this is the cheapest metal. There's no way we're going to use palladium if platinum's a lot cheaper than palladium at this time. So what they're going to do is they're going to substitute wherever they can. And eventually what's going to happen is they're going to over substitute, and platinum will be more expensive than, say, palladium in a lot of those dual use purposes. It also is a function of what the market conditions are. So in inflationary conditions, most of the time platinum it outperforms gold, and it outperforms palladium, and it even outperforms silver sometimes. And silver and gold do very well under other market conditions. Now, do we have this all nailed down, and does everybody know the exact market conditions we're in? That is what the battle is. You're trying to figure that out. And that's what the difficult part of investing is, and that's where patience comes into play. This stuff doesn't turn and move immediately. It takes time. It says for platinum, Andy goes coins bars route. What are people doing for platinum group metal stocks? Anything strike your fancy? And I know someone said PLG, SBSW, Andy's talked about Impala Platinum on the channel before. These are all in South Africa. If South Africa has the energy crisis, well then, what do? Your money is stuck in the very thing that's going to cause platinum prices to go up. 70 or 75%, somewhere around that realm, is produced in South Africa. And I'm not betting that South Africa is going to have an energy crisis. What I'm betting is that the world, it could potentially have an energy crisis for the entire world. That's why I'm doing all of this. I go over all this information on Twitter and stuff, and also the charts to validate that type of viewpoint. So if we have a problem in energy, what's going to happen is your cost curves are going to continually increase. And this is just one potential scenario. Your cost curves increase, so the price of the metal goes up, but your margins on the miners may not go up. So it's difficult to play the mining arena, even though you may be a bull on the physical metals themselves. So just because the physical metals go up does not mean that the miners will make more money. They could go up the same time that the cost curves go up of their inputs, which are subject to inflation. But there could also be times where the metal goes up at a faster pace than their input costs, which will expand their margins. And that's what we're waiting to see with that XAU to gold ratio breakout. It says pure play platinum ETFs have a higher EXP ratio, but I'm considering one. The others have too much palladium, rhodium. Yeah, there's all these other ETFs, exchange traded funds that people want to go into. But guess what? There's something in between you and your metal, and if there is a grave energy crisis, at some point, you're going to have a currency crisis. They're interconnected. Because if you have a problem with increasing GDP because of energy, because energy is directly related to GDP, or GDP is directly related to energy consumption, you're going to have a problem with your currency because your currency has to grow at an exponential speed. Hey, Andy, what do you think about this whole BRICS situation? I'm not exactly sure. I, I mean, I hear a lot, I've seen a lot, and I've seen a lot of things never come to fruition with a lot of the news out there. A lot of people overblow everything. And all I can tell you is you're going to win if you're extremely patient and you buy undervalued assets. You will win at some point, period. But it's going to take time. And a lot of people want things immediately. They want it now. And you know what? Those people maybe aren't cut out to be investors because investors need to be patient and they need to wait for that market condition to come back around for that investment. I think we're close, yes. Are we exactly nuts on it? Don't know. It's hard to tell. The markets are you don't have that type of granularity with the markets. The markets are not granular enough to get short-term predictions right or short-term market estimates. So in the short term, you can't really predict things, even though people are making predictions all the time. I know I do the daily updates, and those aren't necessarily predictions. Those are just probabilities. And the longer you go out and the more extreme your valuations become, either to the upside or the downside, those valuations will eventually change. It's just a matter of time. That is exactly how Buffett invests. So I know this doesn't kind of work with the BRICS situation, but I think the world is searching for a quality asset to back lunacy. The lunacy is the fiat currency system. Some people say, oh, you need it to absorb certain things, like you need the inflation to absorb these deflationary things. It's like, well, the very thing that the fiat created, which is these large fluctuations in movements, is the very thing we need to absorb those fluctuations. I think that argument is a non-argument. You can't get that out of balance on a system that is more rigid. Fiats create these large imbalances. We are working with it's not even a free market anymore. It's kind of like a controlled market where someone controls the price of money, which is your interest rate, and they also control the quantity of money in the system, which is 50% of every transaction. So they control every transaction that occurs in that fiat currency and the price of that currency with the interest rates. Scrolling down, says Andy, would be cool to see a comparison between uranium spot price and interest rate hiking cycles. Uranium spot went parabolic in 2006 toward the end of the rate hiking cycle. It looks like we are setting up that way again, and I completely agree with him. It is setting up that way. Now, here's a couple of different things, and here's a couple of similarities with that. Now, I don't think that the interest rate hiking cycle is 100% the driver. It is part of the driver, yes. What that means is that money is rotating in the system. Now, what we're looking for is an alignment. And obviously, I think Brandon already knows this. The alignment is we want cheap commodities. We want that tailwind of an increasing interest rate environment or interest rate hiking cycle. And then we wait for all this to kind of come in alignment, which we're in. And then we look at the technical charts. And uranium is breaking its first and second. So it's a first wave up, second wave pullback. And we're going to enter what I think is the third wave. These cycles occur under an inflationary period where money rotates away from bonds and away from stocks, perhaps, into these commodities. Now, it doesn't mean that money has to move away from stocks. Stocks can go up at the same time that commodities go up as well. It is possible. But it's also possible that stocks go sideways or even slightly lower at the same time that commodities go up. So we can look and try to see the comparisons in those charts till we're blue in the face, and I don't know how valuable that will be to you. What I would prefer to do, and I'll just pull this up real quick. What I would prefer to do is look at the fractal that is being created in these. So if I go to CCJ to show you guys a comparison fractal, so this is the uranium market. You can see we've got a consolidation zone in the middle here. That's your big 1, 2, 3, big 3-wave consolidation zone. And what I did is I said, why are we consolidating? Why doesn't Camco just go up directly, continuously? Why does it even pull back? And that is one of the things I had to answer. It's the market conditions that are causing it to pull back. This is a recovery phase. It's a recession and recovery phase that this is in. This is the expansionary phase where money rotates differently. Now, what I can do is I can take this fractal, which I think is more valuable than trying to project or predict and look at the Fed funds rate, because we don't know exactly what the Fed funds rate is going to do. And if we take that fractal here, so this is a bars pattern, I take this fractal here. That's the fractal of the last bull market here. I can yank this over here, and you can even manipulate this multiple ways. You could say, well, maybe we are towards the end of this and we move it like that. And we get a fractal that overlays like this. And you're like, well, maybe. You can also get a fractal that we blow it way up. Of course, I grabbed the wrong one here. There we go. There's the tip of it. We get this fractal, we can blow it all the way up, and this could be a potential very big move. And the fractal looks something like that, where if I were to zoom in on it, and hopefully I got this fractal at least overlaid somewhat decently, the fractal is scrunched up and we're starting to move up in a wave 3. So this is wave 1, wave 2 pullback here, and then wave 3 is this big guy. We go sideways, and then wave 5 is this last move higher. Maybe that's the case there. And we moonshot to a much higher level, like way up there, for this big bull market. I don't know. We'll have to wait and see. It is curious, or it is good to see that. So let me compare the two time frames that you're talking about here real quick. You said in yours that 2006 towards the end of the rate hiking cycle. We're not in 2006. So uranium spot went parabolic in 2006. I don't think we're in 2006. 2006 we were in a housing bubble, and the inventory was going way up. We're not in that location yet. So I think we're more like in 2003 if you were to compare to something. We're earlier than what we think. So even though we've got the interest rate hiking cycle and it's coming on up, I just don't see the housing market in the same position. If the housing market is the driver of the interest rates, then it makes me think that we're earlier because we don't have any inventory going up. And in 2006, inventories were rocketing higher. So I think that also matters if that is the driver of inflation. Now, I could be completely off, and that we are earlier in the cycle than what I even think. And the reason I say that is perhaps this inflation was spurred by the stimulus money that went into the system. And some people say, yeah, the housing bubble, we didn't have a bubble. The housing totally done by interest rates. No, it's not. It can't be, guys. It is impossible with that logic. Why is it impossible? In order for home prices to rocket like they did, they must have a bunch of buyers that are out there that are able to buy in order to drive the housing market like it did. Doesn't matter what the interest rates are. You have to have buyers there. And the buyers are there. They are there in droves. So now it comes down to an affordability aspect. Now, could the Federal Reserve spark a recession without sparking a downward move in housing? Yes. And maybe that's what they're trying to engineer. The problem is they're playing with something that's fragile. It's hard to toe the line, to basically make this perfect. They're either going to over print or over tighten. You can't run the line between the two. It's almost impossible to thread that needle. So if they over tighten, what you're going to see is exactly what I think you're seeing. You're seeing the housing market slow way down. And what's going to happen is they're still going to build homes, and we're still going to get buyers buying new homes, because that's where I think the new the demand has to come where that new supply is. We have to increase the supply of homes. Just because I own a home, and if I were to sell a home myself, I have to go buy another house. So what it's doing is it's basically drying up all of the existing inventory and forcing buyers to go buy new homes. We're seeing that the percentage of sales are actually going towards new home builds. And that is going to be inflationary per however many homes they can build. They need to increase the housing stock, which will be inflationary. Now, if they over increase the housing stock and the existing inventory goes up, well, then we're going to see it. And we're going to see the pressures from the housing market, the inventory coming into the market. So when I see this, I mean, I can do that. I can try to compare all that stuff. I just don't know how valuable it is, because the Fed funds rate, yes, we're right there at that cycle. That's what I'll say. We're right there. So if I were to yank it up, I can yank up CCJ and the Fed funds. I put on a new pane on below it, and you can see that we are still increasing the Fed funds rate. And if you look and you were to do a comparison here, we'll do one vertical line. This is when the Fed funds rate basically stopped. We took off during this bottom here in 02. So where exactly are we located? To me, it looks like this lead-in pattern could be this lead-in pattern. Some could even argue, if you were to look at where the bottom was on the ratios was 98.99. So this is the 98.99, and then the bottom of the ratio is around 20.20. So if I were to take the beginning of those, like I did with that bars pattern, and overlay this move as this move here, this is going to show us going to some ridiculous level. Now, could this be, and I'm gonna say this, could we be located in 2000? And we're actually still on this side of it, where we are over here and we could go all the way back down. That could also be the case. It's possible. And what they did is they lowered interest rates, and then they blew it up again. And that's what they did. You can see the interest rates here. They lowered the interest rates. We had a crash here in 2001 and 2 in the tech stocks, and it brought some of the commodities down with it. Then we rocketed higher. Now, here's the thing. We had a slowdown here where we came on back and consolidated. Maybe that was the pullback. Maybe it's not. We had, in this time frame, we had a crash that did not come from the housing market. And I don't know how you can predict this with 100% certainty. What you're going to do is you're going to look, they're going to pause interest rates, and then you'll have a move lower. And I think it could bring commodities back. So I'm not 100% sure where we're located in relationship and how this will interact with each other based off of where we are this exact second. What I can say is we are very low on inventory in terms of existing inventory. We are building homes above average. which is the right ingredients for this to go up. That's what we've seen in history. And what they're trying to do, Powell, the Federal Reserve, is trying to do is slow it down. Now, if they're successful at slowing it down, which I think they have been to some degree, they could break something. And I don't think they're going to break the housing market because we don't have a bunch of forced sellers. So the housing market is strong, and the problem will be somewhere else. It's probably going to be businesses going down or something because of increased interest rates, or maybe it has something to do with car loans. I don't know, something. Whatever it may be. Well, we could see a pullback, and then maybe we could see the big third wave come later. That is also a possibility. Now, what am I going to try to time that? No, because if the housing market's still driving, then I want to stick with that. And I'll ride through whatever pullbacks are going to come or not come. All of these charts in uranium look fantastic. CCJ looks fantastic. I can pull up URA because that's got some data at least. You can see the rate hiking cycle here, but the alignment didn't occur at that time. The alignment occurred in 2020, where we started to move up. We had our interest rates come up, and we consolidated. Now we could potentially be breaking higher here, where we get another wave of inflation, where the interest rates come, they slow everything down, and then another wave comes. But again, I'm in the camp. I don't know absolutely everything. I don't think other people do either, and that's what makes it really difficult. And not many people, I think, have tied inflation and real estate to some of these bull markets. So you can't really look around and try to get someone else to give an opinion, because it's almost like, well, crap, they don't know what's really driving it. They just go off of charts or whatever. And that's their sole thing that they go off of. And charting is good, and technical analysis is good, but what's driving the herd to create the patterns on the technical analysis charts? What is driving it? I would say interest rates are driving part of it. The valuations are driving part of it. And then eventually the deficits and shortages will drive it. But the largest deficits occur when credit is created. And that is what puts those deficits into inflation, so to speak. Like, that's what's driving it. It's a mismatch between credit being created and the supply of those commodities, and the supply of the inputs. I hate how that goes all the way up. What happens when interest rates force, I don't know what STRs are, short-term rates, to lower rates until they're cash flow negative? Do the hundreds of thousands of secondary supply come to market? I think he's talking about homes. Is that what you're talking about? I don't know that question there. I'm going to skip it. Platinum is screaming global M2 money supply is shrinking. Deflation coming based on Andy's past thesis. Granted, all this is probably short term. So I'm not exactly sure with that either, because I know a lot of that money that was created, they're playing games with all that. The Federal Reserve, back in the day, they didn't have this Fed's balance sheet at $7 trillion. They didn't have all this stuff in the system. And when you unwind all of that, money does come out of the system when you unwind that. And it depends on your money velocity as well. If you've got less money moving faster, it can still create the same amount of transactions in the system as more money in the system. So they're yanking money out of the system, but you're seeing your M2 velocity kick up. So if you do M2 velocity times your M2 money supply, we have not seen a contraction in that figure. Let me see if I can find that really quick. What we have there is, let me see if I can find it real quick, guys. Give me a little bit of time. So it is maybe this one. Nope, maybe this one. Nope, maybe this one. There we go. So this is your M2 money supply versus your velocity. It's multiplied together. As you can see, we don't have a contraction in that. and this latest data is June 23. So that is continuing to go up. And what does that mean? It means that your velocity and your M2 money supply are offsetting each other. And you're still getting that same type of boom in the system. This has not fallen yet. So I don't think that inflation is necessarily going to crash yet. We have to see this roll over, and it very well could. But right now, the M2 money supply multiplied by your velocity. This is your velocity here. You can see this is April. It's kicking on up. So there's money in the system that is coming out of the system that isn't creating transactional value, is what I am assuming from looking at this. And this almost looks like, and I'm just going to draw in something, almost looks like a kind of a wedge pattern that's created. You know, some sort of like wedge that's come in here, wedged up, did a false breakout, and then it's like rocketing back to the upside. Looks something like that when I look at it. We've got so that's platinum. Andy, I was looking at the correlation between rates and uranium. Yep, so we talked about that. Listen about silver for 15 years all around. Thanks for the video. Okay. Meanwhile, Patrick tweeted, no reason to be long platinum when it's underperforming uranium the way it is. The TA guys flip-flop so much. I'm still going to keep buying platinum. I'm a buyer when no one else wants it. That's how you make money. I'm still bullish on platinum. So what I'll say there is you are correct. What you want to do is you want to look at and find things that are cheap in the market, accumulate, and have a long-term patient time frame. I've been buying platinum since 2019. Now, someone could say, oh, that's just far too long. Well, I mean, a lot of my platinum buys in 2020 are up dramatically. I did buy at very opportune times. And if I think where we're going occurs in the next however many years, I'm going to be set up very well for my life. If platinum goes to 4, 5, 6, 7, or way above that, whatever it goes to. I don't know what the exact price will go to. The ratios would suggest that platinum will be more expensive than palladium and more expensive than gold, as the majority of history, platinum's been priced greater than gold and palladium. And that is not the case at this time. I don't know what the catalyst will be. People can tell you all these catalysts. They're lying. They don't know what the catalyst is. And this could happen very quickly. So I buy it, I accumulate it when I've got money, and it's cheap. That's the game. Now, I'm not just buying one asset or just one of the other. This strategy works with a basket of assets. It's a diversified portfolio. Platinum is one aspect of the portfolio. I don't buy everything. So I know a lot of people say, oh, I'm going to put all my money in one thing. It's like they're trying to guess which one's going to outperform. Well, what if I said, there's 7 sectors in this world that are dramatically underpriced in relationship to history. And rather than me trying to guess which one that's going to be, I want to get a diversified basket of holding all of those assets. Why is that? Because I don't need to win on all of them if the symmetry is so big to the upside on them. So I am heavily allocated to commodities and precious metals because that is where the value is. I mean, knowing where the value is and knowing how to price assets it's the majority of the battle. Then you have to be patient. You have to take these big swings in volatility if you want to play the game of commodities, and especially the equities, because the equities are volatile as all get out. So you can have people tell me, and I have nothing against Patrick. He's cool, man. Nothing against him. But he might see an opportunity that says, you know what, uranium's way better set up than platinum is. But I'm not going to change my approach. I have allocations. I can tell you this: uranium equities are far more risky than physical platinum. Why is that? Because none of them make any cash flow. So I'm not going to allocate as much to that sector as something that literally is one of the safest investments in the world, which is platinum, gold, and silver. So I don't even think they're worth comparing to because they're completely different assets, and I buy them for completely different reasons. I buy uranium to make purchasing power gains that are ridiculous. I buy platinum to protect my wealth, to get my wealth out of the system, and to play a ratio game that is completely different. So I know people they want to try to guess and predict and try to catch the big wave and have all their money in one sector and catch it. And I understand that need or want to do that, but you're taking on a lot of risk, and it's not part of my strategy to do that. I am not chasing those types of things. I have an allocation to uranium. I have an allocation to platinum and silver and gold. I have allocations to energy in general. And I've got my viewpoints around it. I've got my reasons behind them. And I've got the ratios that are suggesting that these are all underpriced. It says, yeah, some things they say are borderline wild. They talk about potential in the charts. But to go from talking about how excited you are about platinum to saying today that there's no reason to be long platinum is insane. Just turned on a dime. And that's not me. I am very excited about platinum and silver, precious metals, and along with all of the energy sectors. That's my take on it. They're mixing long-term charts with traders' mentality, which seems to be contradictory. Some of their long-term signals. So I'm going to skip over this. I don't want to kind of talk bad about anybody. It's my experience as a landlord, maintenance and improvements eat up most, if not all, the profit for the first couple of years. It is difficult to find excellent tenants also. A person with expectations of perfect cash flow when first turning the spigot needs to be tempered, realizing that they may eventually reach that goal. Yeah, I agree. You're completely right. And that is what scares me away from doing a lot of renting, like buying a house and renting it out. I'm scared about tenants. I'm scared about lawsuits. I'm scared about damage to the house. I'm scared about potential problems that could occur in the house that I'm going to pay for eventually. That could be a broken water pipe that no one reports, something to do with maybe they go through hail damage and I don't know it went through hail damage and no one tells me about it. There's all these different things. And a lot of people that I know that have rented their personal homes have had very bad luck doing that and have had to go to lawsuits to reclaim money back, and it didn't go very well for them. I'll just say that. Hoping for the big breakout in uranium, definitely, guys. And one good way to play it or to look at might be URNJ. URNJ is a junior minor ETF, and that ETF it could be great because what you're doing is you're diversifying your risk amongst the whole sector, and really you're just playing money flows into it. And I think a lot of the junior sector is going to see money flows in general when the uranium sector takes off, and hopefully that captures the big portion of the move in a diversified way. So I think that's a decent way to play it, or look, or at least to look at it. The low inventory of housing in the market is artificial. People are holding on to their homes with locked in low interest mortgages, not wanting to sell it for a new house because then they'll have to get a new very high interest mortgage. That is probably true, but here's the thing. If I own a house and I'm going to go and I need to go live somewhere else, if I'm going to sell this house, that's the problem. You're not increasing the housing stock. You need to increase the housing stock in order to build existing inventory. So new homes have to be built regardless of who buys them. They need to be built so that people move and they open up, some more homes in the system. The problem is if I move, I need to buy a house. And what you're seeing is that people don't want to move and they don't want to pay a higher interest mortgage. So yeah, they don't want to. What's happening is the transaction volume, the sales is going to go down. But that doesn't mean that the housing market is going to go down in price. It just means that your transactional volume goes down. So what I think is going to happen, if I were to take a guess, is existing inventory is going to slow down, like we've seen, and new home builders are going to cater to new home buyers. And hopefully they're building smaller homes at lower price levels for new home buyers. Then the buyers are just going to go straight to the new housing market. And the new housing market is going to make up a larger percentage of sales. That is my guess. Now, I'm not the be-all, end-all expert. That's just me and what I think may occur. But I'm not like the real estate guru. I don't look at every single possible data out there. Some of these guys may or may not, but that's kind of my take on it, of what I've looked at. If I have $1.5 billion, I would buy up all the platinum in the COMEX. Corner in that market, buddy. Yes, 2011 was a great time to buy a home since homes were cheap back then. Today, with record prices and rates, it's the worst time to buy. Buying today with hopes of refinancing is a bad idea. Things are very different today. When the Fed finally lowers rates, do not expect happy days again with rising asset prices. Because of massive debt in the economy and entrenched inflation, when the Fed lowers rates, the dollar and bond market will crash and long rates, including mortgage rates, will spike. I.e., okay, that doesn't make any sense, guys. I'm sorry, Joe, but that does not make any sense, and I'll explain why. What you're saying is we've got record prices on home prices and rates, which makes the affordability poor, which is also saying that we have a shortage in the housing market. That is really what it's saying. It says buying today in hopes of refinancing tomorrow is a bad idea. Things are very different today, which I disagree with, but when the Fed finally lowers rates, do not expect happy days again with rising asset prices. So here's the thing. If the Fed lowers rates, I can refinance. That would be good for that potential outcome. Now, if the Fed lowers rates, you're going to have an onslaught of buyers come, in my opinion, because we are short in the housing market. So if the Fed lowers rates, I get to refinance and I think home prices will go up. And the reason I think that's the case is because we are short homes. The housing stock of inventory is short homes in the market. And then he says, because of massive debt in the economy and entrenched inflation, well, you're contradicting each other here. The housing market, I don't think, has ever gone down in an inflationary period. You're saying that the rates are going to go down and we are in an entrenched inflation period. So when the Fed lowers rates, the dollar and the bond market will crash. That doesn't make any sense in my opinion there. And the reason I think it doesn't make sense is you're saying that we can have poor affordability in the housing market due to interest rates. Then you say when they lower interest rates that I can't necessarily refinance and that home prices are going to go down when they lower rates, which I completely disagree with. If they were to lower rates, home prices, I think, would rocket. And if they got rates down to like 4%, we would see this thing, I think, take off. Then you say because they lowered rates, we're entrenched in inflation, that the bond market's going to crash and long rates, including mortgage rates, will spike. Dollar, sovereign debt crisis. The reason long rates would spike and you have a bond market crash, that I think would cause inflation. It would cause money to rotate out of the bond market, which I agree with. We actually agree on a good portion of this. So where is that bond market money going to go? If trillions of dollars need to exit the bond market, where is that money going to go? And if interest rates go up, you could also say that stocks have a likelihood of crashing. If stocks are crashing, that means people are selling stocks and they're selling bonds. Where is the cash going to go to protect itself from the entrenched inflation that you just described. That is where I think money is going to rotate into housing. And that's where I think money is also going to rotate into precious metals and other commodity assets. That is what the whole thesis basically describes. I think there's a couple of things that we disagree on in the portion up at top. If you've got entrenched inflation, if you've got problems with inflation, then money's got to rotate somewhere. It's going to protect itself. I have never seen an inflationary period where house prices went down. Housing is one of the best inflation hedges. And what you do is you take a loan, a fixed rate loan, and fix it in, and then you let the inflation eat it away. That's why it's such a great investment in an inflationary period. Says, great video, like how your time and audience improve lives, maintain financial security. Yep. Exorbitant, thanks for another great video. Get tired of commenting on this because I never get any feedback. Everybody is so dumbstruck upon looking at the true facts about commodities being so much cheaper than real estate. On this channel, we do know the truth, regardless if most people don't. I conquer that owning a house is good. It's better than renting. However, at present, everybody and their golden retriever is in line to buy a house. That's the herd mentality. This is why houses are expensive compared to commodities. Buying a house should have been done back in 2016 or so. Right now, in most places, it is cheaper to rent than to buy. Let the herd buy a house in these conditions. The herd will never learn. We have already seen how 61% of Americans live paycheck to paycheck, even though every soul in that percentage damned well knows better. The herd will always lose. If you buy a house in these present conditions, you are depriving yourself of optimal investment opportunity. Commodities are where the optimal opportunities are. You'll have an opportunity to buy a house later. It will come. It will be there. Oh, by the way, I also concur that the Fed will most likely end up wrecking the economy at some point. But if the Fed is going to keep fighting inflation with a method designed to rein in bank lending, when excessive bank lending is not even the cause, government stimulus is the cause of this mess. It will bring down inflation. It will instead create stagflation. Commodities are going to fly during stagflation. If you've been on the channel for a while, you should already know this. Yeah, that's a great comment, Hannah. Really great comment. And I think you are most likely right. So to sum that up, the root cause of the inflation is coming from the financial fiscal part of it. It's not necessarily coming from the expansion of the money supply, from credit expansion of the real estate sector. Not all of it. So we are combining that. Basically, we don't have a deleveraging event in the housing market to occur. We don't have forced sellers. But if you've got a government stimulus or the interest payments going up where that money continues to enter the market, that is going to be inflationary. So stagflation, if they are trying to fight inflation with higher interest rates and they slow down the economy, that is where a problem can persist, and the money's going to rotate into commodities, precious metals, and all of those. If you have a shortage in energy, it's going to compound it even further. And that's exact same market conditions as the 1970s. So yeah, Hannah, you're completely right. Coming on down, and this guy's right too, Jonathan. He says, I agree with a lot of what's being said here. However, I think that people always underestimate how far and how long trends can persist. We are short homes. Prices won't budge until we enter an oversupply phase. Close to the 70% of existing homeowners have over 50% equity or a rate under 4%. They're not selling anytime soon. So we mostly rely on new construction to build us into oversupply. He is 100% right. Like you mentioned, there's a lag effect, and we may not see economic pain for years after rate hikes stop. That's when folks will start to panic, sell, and that's when I think it'll be a great time to sell your home, rent, and wait. So obviously, there's a lot of really good opinions out there. I think people are looking at all the right sectors. They're looking at all the right things to make decisions about financial assets and how they should approach it. So I think that's all good. Do I know if a recession's coming? I don't. I don't know exactly. We have an inverted yield curve. That is true. We have an inverted yield curve. Now, is it going to invert further? We'll see. And I know people, they're always going to say, this crash should have already occurred. Should have already occurred. I don't know, guys. I mean, I'm not in that camp. There are lots of technical patterns that we're seeing that are breaking to the upside. Uranium's looking good. Oil's looking good. The curve is inverted, and that's exactly when these take off, is when the curve is basically inverting. So we'll have to wait and see how this all plays out at some point. We're going to have to look at the charts. We're going to have to see what's going on and follow it. And you know what? No one's going to get this 100% right. No one that you listen to on YouTube, and I know you guys probably searching all over the place to see what's going to give you an edge. Finding this opinion. How accurate has this guy been? What's his track record? Not just my track. I'm checking everyone's track record. And what you're going to find is the short term is very hard to get right. So what you have to do is you adapt to that. If the short term is hard, well, what can I do? What is within my control? I can buy assets that are cheap, that I know are cheap with a very high degree of certainty. I know this is cheap. I know this is expensive given some of the tools that we talk about, ratios, market conditions, and all that stuff. And then we can say, I'll just buy a basket of cheap assets and sit on them. That's all I'm doing for the most part. Then you got to say what equities could give me some good upside potential. Where are the big asymmetric bets? I think we've got that covered. And then it's going to be a game against yourself. The game against yourself is, can I hold? And the easiest way for me to hold something is physical metals that are out of the system. You're not seeing that account value go up and down in front of your face. And if the account value is going up and down in front of your face, another easy way that I look at things is, can this produce cash flow in the future? Do I see a line of sight to cash flow? If the answer is yes, then I can hold. It's very easy for me to hold when I see those types of conditions. I don't think a lot of these companies are going to go bankrupt or anything like that. Even if we have a downturn, they basically brought down debt levels dramatically. Cash flows are looking really good on a lot of these companies. And I think better times are still ahead of us, because really what we're trying to look at and what the market is trying to solve here is it's credit expansion in relationship to supply of the commodities. That is really what it comes down to. Credit expansion, supply of commodities, and that's your GDP. If one goes up faster, if this is your money supply and it goes up faster, inflation. And what they're doing is they're trying to slow down what they've normally done. They're trying to slow down lending. That's where the majority of the money comes from. And then they're just pumping money in the back end from fiscal stuff and stimulus and all this other stuff that they want to do. So that's what I've got for today, guys. Hopefully you guys enjoyed it. Give me a thumb up, subscribe to the channel, subscribe to the website if you'd like. A lot of the question and answer sessions go similar to this, but I go into individual companies and stuff like that. And I know a lot of people want to know about individual companies. They want to say, what do the financials look like in this individual company? It's very hard to look at some of the financials in an individual company, a commodity company, because their financials move so drastic in relationship to the price of the commodity or service that they sell. And they don't control the price of that commodity or the service that they sell sometimes. It's basically determined by market values. And that's where the opportunity is. Because the market determines those pricing, and when you get into a shortage, you'll get a gigantic price move, and their margins just blow up. They can have massive margin expansion where they make a buttload of money, and that is where everything gets very interesting in the markets of commodities. That's why I'm there. I want to be in it when that expansion comes, when the market goes into a deficit, prices rise dramatically, and then their margins increase substantially. That's why we're here. We're here to make those 10, 20 baggers. And that's why we go and put up with the volatility. And we can do that in a much shorter time frame than tech stocks and a lot of these other stocks can do it. But you gotta have a certain type of mindset. You gotta look out ahead and try to hold through this stuff, which is tough. Even tough for me sometimes. I don't like seeing a bunch of volatility. It's like, ugh, I don't want to see my account, move up and down that amount. But that's what I've got for today, guys. Hopefully this is worthwhile for you. But that's all I've got, and we'll catch you next time. This is Finding Value.